When you think about the engines of the global economy, your mind probably jumps to the US, China, or Europe. But what if I told you that two seemingly smaller economies down underhold the keys to predicting major financial shifts across the entire Asia-Pacific? Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we re-unpacking why the interest rate decisions made in Australia and New Zealand send powerful shockwaves through global finance, shaping everything from currency markets to trade balances across Asia. It's easy to dismiss Australia and New Zealand as minor players on the world stage. After all, their GDPs don't rival those of economic titans. However, this view overlooks a crucial factor in the world of global finance. Openness and integration often matter more than sheer size. Both nations have highly open markets, are deeply integrated with global trade, and maintain strong economic ties to Asia. This unique position means their central banks, the Reserve Bank of Australia (RBA), the myth that smaller GDP equates to smaller influence is quickly debunked in financial markets, because capital can flow freely in and out of both economies with minimal friction. Even small adjustments to their monetary policy can send powerful signals to global investors, hedge funds, and commodity traders. This makes Australia and New Zealand small but powerful financial actors whose actions have an outsized impact. Their currencies, the Australian dollar AUD and the New Zealand dollar NZD, are far from niche. They are among the most traded currencies in the world. Investors flock to them for several key reasons: gaining exposure to commodity price movements, executing carry trades, hedging against global inflation cycles, and diversifying their portfolios away from the US dollar, euro, and Japanese yen. The high liquidity and inherent volatility of the AUD and NZD amplify the global impact of every interest rate announcement from Canberra and Wellington. To understand their influence, you first have to grasp the structure of their economies. Australia and New Zealand are textbook examples of highly globalized, trade-dependent nations. They are deeply embedded in global supply chains, but with a strong focus on raw materials. Australia is a powerhouse exporter of minerals, metals, and energy, while New Zealand's economy is driven by agriculture, dairy, and food products. This heavy reliance on commodity exports makes them extremely sensitive to the ebbs and flows of global demand. This commodity-driven nature means their economies experience larger and faster financial swings than more diversified nations. When global commodity prices surge, inflation in Australia and New Zealand often rises faster. Conversely, when prices fall, economic demand can drop off a cliff. This dynamic forces the RBA and RBNZ to be more reactive and adjust interest rates frequently, a practice that immediately captures the attention of global markets looking for clues about where the world economy is headed. Their open capital markets act as a massive amplifier for these policy changes. Nearly all major financial institutions in Australia and New Zealand borrow funds on the international stage. So, when the RBA or RBNZ raises interest rates, the effect is instantaneous and capital flows shift in the blink of an eye, impacting global bond markets, currency demand, regional banking systems in Asia, and the strategic decisions of foreign investors everywhere. This extreme openness is precisely what makes their domestic policies globally relevant. So, how exactly do interest rate changes in these two countries influence their currencies, the AUD and NZD? One of the primary mechanisms is the carry trade. This is a strategy where investors borrow money in a currency with a low interest rate like the Japanese yen or Swiss franc, and then invest it in a currency with a higher interest rate such as the AUD or NZD. The investor pockets the difference in interest rates, known as the carry, because of their historically higher rates compared to other developed economies. The AUD and NZD are two of the world's most popular carry trade currencies. When the RBA or RBNZ signals a rate hike, it's like a green light for these traders, causing a sharp increase in demand for Australian and New Zealand dollars. The relationship between interest rates and currency strength is straightforward. Higher interest rates generally lead to a stronger currency, as global capital chases higher returns. Lower rates tend to weaken a currency because the AUD and NZD are so heavily traded. Any announcement from their central banks can trigger immediate and significant volatility in the foreign exchange market. This doesn't just affect traders. It has a ripple effect on all of their regional trade partners. The AUD and NZD often act as proxy currencies for risk sentiment in the entire Asia. When these currencies strengthen or weaken, investors take it as a signal to adjust their positions in Asian bonds, other regional currencies, and stocks of export-oriented companies, creating cascading effects across multiple markets. These actions create significant spillover effects throughout the Asia-Pacific region, primarily through capital flows. When interest rates in Australia or New Zealand rise, global investors move money into a UD and NZD-denominated assets to capture those higher yields. This movement often pulls liquidity out of neighboring emerging markets like Indonesia, Malaysia, Vietnam, and the Philippines. The result is a tightening of financial conditions across Asia, making it more expensive for businesses and governments to borrow money. This shift also impacts bond yields and broader investor sentiment. Australian and New Zealand government bonds are widely viewed as safe, stable, and higher-yielding alternatives to those of other developed nations. When their yields rise, global investment funds often rebalance their portfolios, selling off Asian bonds or even U.S. Treasuries to buy Australian or New Zealand debt. This rebalancing can cause borrowing costs to rise across the entire region. Furthermore, a stronger AUD and NZD makes exports from Australia and New Zealand more expensive on the global market. This directly shifts trade patterns in the region, affecting the competitiveness of countries that sell similar products like beef, dairy, wheat, coal, or metals. Another critical spillover effect is on bank funding costs. Many Asian banks raise capital in global markets, often priced in US dollars. When rising interest rates in Australia and New Zealand contribute to a higher global cost of credit, it becomes more expensive for these Asian banks to secure funding, which can lead to tighter lending standards and slower economic growth across the region. Because of these powerful ripple effects, Australia and New Zealand have become crucial economic signals for the rest of the world. They often serve as early indicators of global inflation. Due to their open, commodity-sensitive economies, they tend to feel inflationary pressures sooner and more acutely than larger, more diversified economies. Consequently, their central banks are often forced to act earlier, hiking or cutting rates before the U.S. Federal Reserve or the European Central Bank. This makes RBA and RBNZ decisions a leading indicator for global monetary policy cycles. Historically, the RBA and RBNZ have often been the first movers among developed economy central banks to change their policy direction. Whether it's tightening to fight inflation or loosening to stimulate growth, This gives global markets an invaluable early forecast of where monetary policy is heading globally. For analysts focused on the Asia-Pacific, changes in commodity demand, trade shifts, and inflation trends often appear first in Australia and New Zealand, allowing them to predict broader regional economic trends with greater accuracy. The influence of these two economies isn't confined to Asia. It extends to the United States, Canada, and the United Kingdom as well. When yields on AUD and NZD assets become more attractive, investors in Western countries shift capital out of US dollars, Canadian dollars, and British pounds to pursue those higher returns. This affects bond yields, credit markets, and currency positioning in Western economies. US and UK-based hedge funds also frequently use AUD and NZD futures and options as powerful hedging instruments, as both currencies respond sharply and predictably to shifts in global risk sentiment. Finally, as key global suppliers of commodities, changes in their monetary conditions can alter the prices of iron ore, liquefied natural gas, dairy, and other agricultural products. This has a direct impact on commodity-dependent economies like Canada, as well as agricultural sectors in the U.S. Midwest and the food market in the U.K. Let's look at some recent case studies. The RBA's series of aggressive rate hikes between 2022 and 2024 successfully cooled domestic inflation, but they also caused strong volatility in the AUD. This reshaped trade balances in Asia and led to a tightening of regional credit conditions. In another example, the RBNZ shocked global markets by being one of the first central banks to hike rates after the pandemic. This decisive move immediately strengthened the NZD, triggered widespread expectations that other central banks would soon follow suit, and forced a reevaluation of bond portfolios across Asia and Europe. These events highlight how hedge funds' use of AUD and NZD for carry trades ensures that any rate change causes rapid and significant adjustments in global currency and bond markets. However, there are risks associated with misjudging RBA and RBNZ policy. Unexpected policy moves can lead to overheated currency markets, where excessive capital inflows push the AUD or NZD to unsustainable highs, damaging their export competitiveness and setting the stage for a sharp correction. Sudden rate hikes can also trigger liquidity shocks in developing Asian economies, as capital is abruptly pulled out, potentially leading to market instability. These policies can also fuel commodity price spikes and create volatility in global bond markets, as large funds are forced to rebalance their portfolios. Looking ahead, will Australia and New Zealand continue to lead global monetary cycles? It seems likely. Their ongoing reliance on commodities and high sensitivity to global economic cycles will probably keep them in the position of first movers. The economic health of China, their largest trading partner, will remain a critical factor. Any slowdown or recovery in China will deeply affect their inflation, trade, and, consequently, their interest rate decisions. As central banking evolves, the increasing use of AI and real-time data will give the RBA and RBNZ even greater agility, potentially making their global impact sharper and faster than ever before. In conclusion, it is crucial for regional economies and global investors to closely monitor the policy decisions of the RBA and RBNZ. Their actions directly influence currencies, trade flows, capital markets, and commodity pricing not just in the Asia-Pacific, but across the world. The global impacts can be summarized as increased currency volatility, major shifts in investor sentiment, changes in trade competitiveness, fluctuations in commodity cycles, and significant bond market adjustments. These two small but powerful economies truly punch above their weight, acting as the canaries in the coal mine for global finance. What are your thoughts on the outsized influence of Australia and New Zealand? Leave your questions in the comments, share this video with friends interested in global finance, and subscribe for weekly macroeconomic deep